December 31st, 2024. A commodities trader in Singapore stares at his screen, coffee growing cold in his hand. Silver just crossed $79 an ounce. 7 days ago, it was $32. His fingers hover over the keyboard, frozen. In 30 years of trading, he's never seen a structural metal double in a week. 3,000 miles away, a supply chain manager at a solar panel factory in Arizona gets the call she's been dreading. Their silver supplier can't fulfill the contract, not at any price. The panels they promised to deliver next quarter, panels already sold, already contracted, will cost more to build than they'll sell for. Every unit shipped is a loss. This isn't speculation. This isn't a bubble. This is what happens when a commodity the entire modern economy depends on runs out. When 600 million ounces of annual industrial demand meets 830 million ounces of supply, and China just locked down 25% of global refining. There's a pattern in history when essential commodities break their supply chains. Oil in 1973, silver in 1980, rare earths in 2010. Each time governments tried everything. Price controls, strategic reserves, diplomatic pressure, export restrictions, currency intervention. Each time they discovered the same truth. You cannot print silver. You cannot legislate geology. You cannot control what you don't have. And right now, the United States government has zero silver reserves. Zero. 3 times in the last 50 years, commodity shocks have crashed markets and exposed the absolute limits of government power. Each time, the pattern was identical. Each time, the people who understood the pattern got rich. The people who didn't lost everything. We're watching it happen again, right now, in real time. Let me show you the pattern, the history, and why this time the crash will be worse than anyone expects. Before we examine the pattern, you need to understand why silver is different from any other commodity on Earth. This isn't gold. Gold sits in vaults. Gold is jewelry and investment. Gold is optional. Silver is not optional. Silver is the most electrically conductive metal known to science. Nothing else comes close. This makes silver irreplaceable in the technologies that define modern civilization. Every solar panel requires 10 to 20 grams of silver. Every electric vehicle uses 25 to 50 grams. Every 5G tower requires 3 to 5 times more silver than 4G towers. Every smartphone, every computer, every piece of medical equipment, silver. Total industrial demand, 600 million ounces per year. And this demand is not discretionary. You cannot substitute silver in a solar panel and still have a functioning solar panel. The laws of physics don't negotiate. Now here's where the math becomes terrifying. Total silver mined annually, 830 million ounces. That sounds like a surplus, but add investment demand, people buying silver as money, as a hedge, and you get 200 million more ounces of demand. Total demand, 800 million ounces. Total supply, 830 million ounces. That's a 30 million ounce surplus on paper. But the mining supply isn't growing. Silver production has increased less than 2% per year for the last decade. And here's why. Silver is a byproduct. 70% of all silver comes from mining copper, lead, and zinc. The real deficit, when you account for stockpile depletion, has been running 200 million ounces per year. Where does that silver come from? Existing stockpiles, government reserves, private hoards, and those stockpiles are now nearly exhausted. The United States government holds zero silver reserves. Zero. They sold the last of their strategic silver stockpile years ago. When this shortage bites, there is no emergency supply to release. Now let me show you the 5-stage pattern that plays out every time an essential commodity faces structural shortage. Stage 1. Supply restriction. Something disrupts the normal flow of the commodity. War, policy change, geological depletion, cartel action. Stage 2. Price explosion. Prices spike as markets discover there isn't enough physical supply at any price. Stage 3. Industrial cascade. Companies that depend on the commodity face margin compression, contract losses, and potential bankruptcy. Their stock prices collapse. Stage 4. Government response failure. Politicians try every tool available: price controls, reserve releases, diplomatic pressure, emergency legislation. None of it works because governments cannot create physical commodities. Stage 5. Wealth transfer. The people and institutions who understood the pattern and positioned beforehand capture enormous wealth. Everyone else pays the price. October 1973, the Yom Kippur War begins. Arab members of OPEC announce an oil embargo against the United States and other Western nations supporting Israel. Before the embargo, oil traded at $3 per barrel. Within months, it quadrupled to $12. The United States government, the most powerful nation on earth, tried everything. Price controls. President Nixon implemented price ceilings on gasoline. The result? Shortages. Gas stations ran dry. Americans waited in lines stretching for miles. The price controls didn't increase supply, they just made the shortage worse. Strategic reserve release. The U.S. tried to release oil from reserves, but the Strategic Petroleum Reserve barely existed in 1973. There wasn't enough oil stockpiled to matter. Diplomatic pressure. Henry Kissinger flew to Saudi Arabia, to Kuwait, to every OPEC nation. They ignored him. The embargo continued. Rationing. Some states implemented odd-even rationing based on license plate numbers. It created chaos without solving the underlying shortage. Currency intervention. The Federal Reserve printed money, trying to stimulate the economy through the shock. It created inflation without increasing oil supply. The result? Inflation hit 12%. Unemployment rose to 9%. The S&P 500 fell 48%, losing nearly half its value in the crash of 1973-74. The government tried every tool in its arsenal. None of them created a single additional barrel of oil, because you cannot print oil. You cannot legislate geology. When physical shortage binds, government power ends. Stage 1, supply restriction. Check. Stage 2, price explosion. Check. Stage 3, industrial cascade. Check. Stage 4, government response failure. Check. Stage 5, wealth transfer. OPEC nations accumulated hundreds of billions in petrodollars while American consumers and investors lost fortunes. The pattern completed in 18 months. The wealth transfer was permanent. Now let's look at what happened when silver itself spiked. Different mechanism, same pattern, same government powerlessness. Nelson Bunker Hunt and William Herbert Hunt were Texas oil billionaires. In the late 1970s, they became convinced that inflation would destroy the dollar. Their solution, buy silver, all of it. Starting in 1973, the Hunt brothers began accumulating physical silver. By 1979, they controlled an estimated 100 million ounces, roughly half the world's deliverable supply. Silver prices rose from $6 per ounce in early 1979 to $49.45 per ounce on January 18, 1980, a 717% increase in less than a year. The U.S. government watched in horror. Silver was used in photography, electronics, jewelry. Industry was screaming. Consumers couldn't afford silverware. What could the government do? They couldn't confiscate the silver. The Hunts owned it legally. Private property rights still existed. They couldn't increase supply. Mining takes years. There was no silver to release. The government had already sold its reserves. They couldn't impose price controls. That would just create shortages, like with oil in 1973. So the government did the one thing it could do. It changed the rules of the game. The COMEX, the commodities exchange where silver futures traded, suddenly raised margin requirements. Overnight, the amount of cash required to hold silver futures positions increased dramatically. On March 27, 1980, Silver Thursday, the Hunts failed to meet a margin call of $100 million. Silver prices crashed from $49 to $11 in 2 months. The government won, but only because the Hunts had used leverage. They'd borrowed money to buy silver. When the rules changed, their debt destroyed them. Here's the critical lesson. If the Hunts had owned their silver outright, no debt, no margin, just physical metal, the government would have been powerless. The only vulnerability was the debt, the leverage, the paper promises. The pattern completed. But it revealed something important. Government power over commodities extends only as far as the financial system. When someone owns physical metal without debt, the government has no tools. Remember that. It matters for what's happening right now. September 2010. A Japanese Coast Guard vessel collides with a Chinese fishing trawler near the disputed Senkaku Islands. Japan arrests the Chinese captain. China's response: they cut off rare earth exports to Japan. Rare earth elements, neodymium, dysprosium, terbium, are essential for magnets in electric vehicles, wind turbines, smartphones, and military equipment. At the time, China controlled 97% of global rare earth production. Within weeks, rare earth prices increased tenfold. Some elements rose 2,000%. Japanese manufacturers panicked. Toyota, Honda, Sony, companies that couldn't build products without rare earths, faced potential production shutdowns. The U.S. government tried to intervene. They filed complaints with the World Trade Organization. China ignored them. They tried to restart domestic rare earth mining. But mines take 7 to 10 years to develop. The shortage was immediate. They tried diplomatic pressure. China made vague promises and continued the restrictions. They tried to develop substitutes. For some applications, substitutes existed. For many, they didn't. The laws of physics constrained the options. The result? Companies paid whatever China demanded. Prices stayed elevated for years. The wealth transferred to China. Western companies and consumers absorbed the cost. The WTO eventually ruled against China in 2014. 4 years later. By then, the damage was done. The pattern had completed. Stage 1. Supply restriction. Check. Stage 2. Price explosion. Check. Stage 3. Industrial cascade. Check. Stage 4. Government response failure. Check. Stage 5. Wealth transfer to the entity controlling the supply. 3 times in 50 years. 3 different commodities. 3 different mechanisms. The exact same pattern. The exact same government powerlessness. Now, let me show you why what's happening with silver in 2024, 2025 is worse than all 3. Stage 1. Supply restriction. December 15, 2024. China announced export licensing requirements for silver products effective January 1, 2026. New rules eliminate small and medium exporters. Only large government-approved refiners can export. China refines 25% of the world's silver supply. The new regulations will remove an estimated 150 to 200 million ounces of annual supply from global markets. This isn't speculation. This is announced policy. The supply cut is coming. Check. Stage 2. Price explosion. 1 week ago, silver traded at $32 per ounce. Today, it trades at $79 per ounce. A 147% increase in 7 days. This isn't a normal price move. This is structural break. The market is discovering that there isn't enough physical silver at any price. Check. Stage 3. Industrial cascade. This is where it gets terrifying. Solar companies built their business models on $25 silver. First Solar, Enphase, SunPower. They signed long-term contracts promising to deliver panels at fixed prices. Those contracts assumed silver would stay around $25 per ounce. At $25 silver, 10 to 20 grams of silver per panel costs $8 to $16. At $79 silver, that same silver costs $25 to $50 per panel. Silver cost tripled. But the contracts are fixed. The companies can't raise prices. Every panel they deliver now loses money. A backlog that was supposed to generate $2 billion in revenue now generates $500 million in losses. First Solar traded at $280 in early 2024. If silver stays at $79, that stock could trade under $100, a 64% collapse. Electric vehicles face the same math. Tesla uses 25 to 50 grams of silver per vehicle. At $25 silver, that's $20 to $40 per vehicle. At $79 silver, that's $63 to $126 per vehicle. An additional $86 cost per car. Tesla produced 1.8 million vehicles in 2023. Multiply by $86 and you get $155 million in additional annual costs. Tesla trades at 70 times earnings based on projected 20% growth and expanding margins. If growth slows to 10% and margins compress, the stock reprices 50% lower. Apple ships 230 million iPhones annually. At $79 silver versus $25 silver, that's an additional $70 to $175 million in annual costs. Just for silver. Tech, renewable energy, industrials, and materials represent 40% of S&P 500 market capitalization. If these sectors re-rate by an average of 15%, the S&P 500 falls 6% from sector rotation alone. Rising commodity costs feed inflation. The Federal Reserve keeps interest rates higher for longer. Higher rates compress all equity valuations. The NASDAQ could fall 20% if rates rise another percentage point. Hedge funds that are short commodities and long equities face margin calls. They have to sell stocks to meet the calls. Forced liquidation creates a feedback loop. Selling begets selling. The cascade is beginning. Check. Stage 4. Government response failure. This is where the pattern becomes inevitable. What can the U.S. government do? Release strategic reserves? The U.S. government has zero silver reserves. There is nothing to release. Impose price controls? Price controls on commodities create shortages, not supply. We learned this in 1973 with oil. The gas lines stretched for miles. Export controls. The United States produces only 5% of global silver supply. Banning exports does nothing when you have almost nothing to export. Mining subsidies? New mines take 7 to 10 years to develop. The shortage is now. Currency intervention? You can print dollars. You cannot print silver? Printing more dollars just makes the silver more expensive in dollar terms. Diplomatic pressure? China announced these restrictions knowing the consequences. They have leverage. We don't. Every tool either doesn't exist, doesn't work in globalized markets, takes too long to matter, or creates bigger problems than it solves. The government is powerless. Check. Stage 5. Wealth transfer. Here's what nobody is telling you. Over the past 15 years, large banks have systematically accumulated physical silver. They crashed paper prices during thin trading, overnight sessions, holiday weekends, then bought physical metal at the suppressed prices. The evidence is documented. J.P. Morgan paid $920 million in fines for manipulating precious metals markets. The practice was illegal. They paid the fine. And they kept the silver. Estimates suggest these banks accumulated 500 to 750 million ounces over 15 years. At $25 per ounce, that position was worth $12.5 to $18.75 billion. At $79 per ounce, that position is worth $39.5 to $59.25 billion. They paid $920 million in fines. They made $27 to $41 billion in profit. The wealth transfer is happening right now, from solar companies, from EV manufacturers, from tech stocks, from retail investors holding those stocks, to the banks, to the institutions, to the people who understood the pattern. Check, 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 check. All 5 stages. Confirmed. 3 times in 50 years. Commodity shocks crashed markets and proved governments powerless. Oil in 1973. Silver in 1980. Rare earths in 2010. Each time, the pattern was identical. Supply restriction, price explosion, industrial cascade, government failure, wealth transfer. The 2024-2025 silver shock is following the exact same pattern, but this time is different, worse. In 1973, oil was discretionary for some applications. Silver is not discretionary. Solar panels don't work without silver. EVs don't work without silver. 5G towers don't work without silver. In 1980, the Hunt brothers were 2 men with borrowed money. Today, the accumulation is distributed globally. Hundreds of institutions, millions of individual investors. There is no single target to attack. And here's the darkest irony. The green energy transition, solar panels, electric vehicles, wind turbines, was mandated by government policy. Governments created the demand, subsidized it, required it. But governments cannot control the supply. The very policies governments enacted to transform energy are now crashing into physical limits those governments cannot overcome. The only question is whether you understand the pattern before it completes or after. If this opened your eyes to what's actually happening, if you see the pattern now, subscribe. The answers aren't hiding in the future. They're written in the past. And the past says you cannot print silver, you cannot control what you don't have, and the government doesn't have any.